Hi there, Stan, the Annuity Man, America's annuity agent, licensed in all 50 states. Today's question is a good one. Hey, Stan, what's this exclusion ratio thing I've been hearing about? What's an exclusion ratio? Why are they excluding it? I don't want anything excluded. I want it all, Stan. I want it all with my annuity type. There's many different types. We're going to talk about exclusion ratio and how to look at that, how to go to my site at theannuityman.com and see it after this. Okay, exclusion ratio, what is that? It really revolves around annuities that provide lifetime income, single premium immediate annuities, deferred income annuities, annuities that are, in essence, annuitized. Not all lifetime income stream payments are annuitized. Income riders can be a drawdown product. Drawdown means subtraction in the South. But we're going to talk today about exclusion ratios and how to look at that on my site when you run quotes at theannuityman.com and what that means. What is an exclusion ratio? So let's go backwards a little bit and let's focus on two primary products for lifetime income that are both annuitized. Single premium immediate annuities and deferred income annuities. There's also a third one called qualified longevity annuity contracts that are in essence a deferred income annuity but only used for IRAs. But for today's conversation, immediate annuities, deferred income annuities. And you say, wait a minute, what's the difference? Pretty much the same chassis. The difference is when you turn on the income stream. So with a single premium immediate annuity, that income is going to turn in a year or less, so 30 days up to a year. With a deferred income annuity, it's really an immediate annuity that magically becomes a deferred income annuity after that year deferral. So you can defer it for 13 months, 5 years, 30 years, 10 years, 7 years, etc., deferred income annuity. Now, with lifetime income payments with annuities, that lifetime income payment is a combination of return of principal plus interest. And you say, wait a minute, whoa, return of my principal plus interest, what? Yeah, that's what a lifetime income stream is. And the true benefit proposition of an immediate annuity and a deferred income annuity is it's going to pay you for life. We'll structure it so that 100% of any unused money goes to the beneficiaries when you die. But as long as you're breathing and or on a respirator, it's going to pay for as long as you live. But remember what I said, a combination of return of principal plus interest, okay? Now, let's go and look at the types of accounts you can use deferred income annuities and immediate annuities in, all of them. Non-IRA, IRA, Roth IRA. So let's look at Roth IRA. SPIAs and DIAs in a Roth IRA, tax-free income because you've already paid the taxes on the Roth to convert it. On IRA, SPIAs and DIAs both, the income coming out of both of those with IRA assets, that income stream is going to be fully taxable because, like everything you pull out of your IRA that's been deferring, when you take money out, it's taxable, okay, at ordinary income levels. But exclusion ratio truly applies to when you're using non-IRA assets. Checking accounts, savings accounts, non-IRA, non-qualified, as they call it in the business, assets. And when you run a site at theannuityman.com, you run an immediate annuity site or deferred income annuity, and you use non-qualified assets, or let's just say you want to use IRA money and you want to know what the exclusion ratio is, run it non-qualified, non-IRA, and you will see the grid come up and it'll show the top companies that have the highest payouts available for your specific situation. And you understand that the older you are, the higher the payments. It's primarily based on life expectancy. But it will segment out, here's your lifetime income payment, here's the interest portion of that. So let's just say the lifetime income payment is $2,000 a month. It will, in non-qualified, it will show you that maybe $400 of that is interest. So if you go to the end of the year and you pay taxes, you're only going to pay taxes on the interest portion, the exclusion ratio portion of that lifetime income in a non-IRA account. All right? So people always say, well, wait a minute, lifetime income, return of principal plus interest, shouldn't I just watch the Fed all the time to see how that's working and time it and try to find the sweet spot or the arbitrage moment to buy it? No, because the life expectancy part is the driving of, that drives the pricing train. Older you are, the higher the payment, younger you are, the lower the payment, just because it's life expectancy based. But if you wanted to say, Stan, what's the interest rate kind of bogey that I need to look at? It's probably the 10-year Treasury on that exclusion ratio part. Now, that's not 100% math correct because it's a commodity product and these companies bid on your business based upon the tranche they want to fill with your age range, but that gives you a good feeling of what that interest part will be. Now, when you buy an immediate annuity with non-IRA money and you buy a deferred income annuity with non-IRA money and you know what that exclusion ratio is going to be, you've locked it in. It's not going to fluctuate, move up and down, etc. That's it, period. So let's look at those types. You buy, once again, remember, you can buy these in IRAs and Roth IRAs as well, but we're talking about exclusion ratio, which is primarily the non-IRA portion. So let's just say you bought an immediate annuity or deferred income annuity, and you know what the exclusion ratio is, which is that interest portion of which you're going to be paying taxes on every year. But let's just say you live forever. So for 20 plus years, you've been just paying the taxes every year on that interest portion. Hey, Stan, what happens when the annuity goes to zero in value and I'm still getting the payments? Is there still an exclusion ratio? The answer is no. At that point in time, when there's zero in the account and you're still getting that income stream because that's the transfer of risk benefit, then all of that income is going to be taxable, but not until you get to zero. Up until that point, you're only paying taxes on that interest portion, okay? Not the principal, in a non-IRA setting. So when we get back to the original question, what is the exclusion ratio? It applies to everything that's annuitized, single premium immediate annuities, deferred income annuities, qualified longevity annuity contracts. All of them are return to principal plus interest, but the exclusion ratio really applies from a taxation standpoint when you're using non-IRA assets. I know I threw a lot at you, but I think I explained it very simply because I'm from the South and that's what we do. But if you have questions, go to my site. You can download books on, and for free, PDF owner's manuals on deferred income annuities, immediate annuities, qualified longevity annuity contracts. I've done a myriad of videos on all of these. You can schedule a call with us as well. You can listen to my podcast. We're here to educate you, but before you buy anything, you're going to fully understand the exclusion ratio. You're going to fully understand what's taxable based upon the account that you're using. We're going to explain all of that and then leave you alone to make your decision on your terms and on your time frame. Hope that helped. Hope that clarified things. I'm sure it did, and I look forward to speaking with you. Go to my site at The Annuity Man, hit the subscribe button, and I'll see you on the next Stan the Annuity Man YouTube video.